second part before we pass over to Harry to do the third part. So what I want to be focusing on is some of the practicalities of calculating expected credit losses, with particular emphasis on related party loans.
Lawrence, we cannot hear you.
Is that better? Can you hear me now?
Yes, now we can hear you.
My
All right, no worries.
Okay. So just very briefly, I just will tell you who I am. I am a chartered accountant by training, but I've spent most of my professional career working in the area of credit risk management. Most major part of my career was at Moody's, the rating agency, and their credit services subsidiaries, and the First Rank Group, which is South Africa's largest banking group. I am one of the co-founders of I9 Partners. We provide services in the IFRS 9 space. So just as a general note, what I'm going to be talking about this morning is on how to measure the expected credit losses. I am not going to be focusing on the accounting interpretations. So I'm going to assume that any financial assets that I refer to are subject to an expected credit loss calculation. When it comes to related party loans, most loans are going to be subject to an expected credit loss, but there are certain accounting technicalities that may cause, for example, a loan to a subsidiary to be treated as part of the equity investment and therefore not subject to expected credit losses. But that is not what I'm going to be focusing on. I'm assuming that expected credit losses are applicable, which will be the case in the vast majority of related party loans. So, as a starting point, what is different about related party loans? So what I firstly want to mention is that in terms of calculating expected credit loss, there is no change in any of the requirements for calculating expected credit losses as a result of the fact that there is a relationship between the parties. In other words, we still have to measure the risk in the same way. But that doesn't mean that the relationship between the borrower and lender is not relevant. It could well have an implication for the risk that we are measuring. And on a practical basis, we need to remember that it's quite possible that related party balances arise due to informal arrangements. So sometimes we don't always know what the precise terms of a loan are. We also don't always know when the original loan was made, which is going to be a very important point as I'm going to come to. On the other hand, there's often an assumption because they're related party that you will have access to financial information about the borrower. So that is a third point that I want you to bear in mind when we're looking at related party loans. So when we are looking at measuring the expected credit losses on a loan, the starting point is going to be to consider the term of that loan. Every loan has a term. It may be repayable on demand, or it may be at some future fixed date. Very often in related party loans, there is no repayment term stated. Either there's no formal legal agreement regulating that loan, or there is an agreement, but it doesn't say when the loan is due to be repaid. The majority interpretation for IFRS 9 is that such a loan should be assumed to be repayable on demand. But there are some references, some people do make the case that you can say that a local practice may override this. That said, it is not a simple argument to make, and it is probably the safer treatment to assume that a loan without stated terms is repayable on demand. So I'll just very briefly show you, we have an online system that we are about to go live with, which automates and templatizes the calculations of your expected credit losses on related party loans. And we just have different options on loan terms, be it fixed, repayable on demand, or no fixed terms. So if I look at loans repayable on demand, I want to briefly look at one specific aspect of them before we get into the calculation of expected credit losses, because there are certain unique requirements related to a loan repayable on demand. The first thing we have to do is understand that IFRS 9 says that where a loan is repayable on demand, it is assumed that at the measurement date, the repayment had been demanded. So in other words, a loan repayable on demand, if my year end is 31st of December, we calculate the risk as if demand had been made to repay it on the 31st of December. So what we then do is have a look at the borrower entity and say, did it have sufficient cash or near cash? So in other words, highly liquid investments, things like money markets investments, in order to make that repayment? If it did, IFRS 9 will say to us that the period of the repayment is so short that the expected credit loss is very close to zero, and we can assume that we don't need to provide for it. So that is in the circumstances where a loan is repayable on demand and when there is sufficient cash at the measurement date to make repayment. We do not need to provide for the expected credit loss, just to emphasize that that needs to be unrestricted cash that we could have access to for purposes of repayment. Where we have the situation where there's insufficient cash to repay, I'm going to return to later in the presentation, and that is the usual situation. So I will come back to that a little bit later. So now, I'm talking in general, once again, about all loans, not only referring to loans repayable on demand. How do we measure the expected credit loss? So IFRS 9 requires us to measure the risk of credit loss as of today based on probability weighted outcomes. So in other words, what are possible outcomes in terms of future cash flows that we're going to receive from that loan, both payments of interest and capital if applicable, taking into account the time value of money. So if we look at that definition, that actually raises some very important points. If our measurement of risk has been based on some sort of measurement scale that is based on data over a period of time. So let's say we built a credit model that has data over time. We need to convert that risk that has been determined over a period to today's risk. Because IFRS 9 says we have to measure the risk as of today, and then we have to overlay macroeconomic forecast scenarios. So in other words, we've got to say, what are possible cases or different situations for the economy over the term of that loan? And from that, we determine probability weighted different forecasts, and we use those to determine the expected credit losses. I will go in practical terms what that means a little bit later in the presentation. And then another point to remember is that the staging of loans of financial assets applies to related party loans. So our staging applies to everything other than trade receivables, or there's an option for lease receivables to be treated on the simplified basis, but related party loans will be on the comprehensive basis. So, to measure that risk, IFRS 9 doesn't require us to use this framework, but it is the most commonly used framework to measure risk, and that is to split it into its component parts. The reason it is useful is that each of those component parts behaves differently in different scenarios. So if we measure the risk all in one, it is more difficult to understand what the impact of converting it from an average point in time, average through the cycle measure to what is today's risk and into the future expected credit losses. So the three elements of risk are the probability of default, my PD, how likely is the entity to default, and we usually measure that in a straightforward percentage term, and it's going to always have a term over which period are you measuring it. The second point is, if you do default, how much will be owed at the point of default? Exposure at default. That's how we know how much is at risk. And my third point is, if I know how likely we are to default, if we know how much we are owed at point of default, my third point, how much will I actually lose, my loss given default? Now I'm going to go down into a bit of detail on each of those 3 points so that you understand what the difference is, and that will link directly to the practicalities and how I measure it. So a default is the situation where the credit risk has increased significantly. In other words, we are now in a situation where the risk of loss, either due to a capital loss or due to a delayed payment, because we take into account time value of money, that risk has increased significantly, and there's a strong likelihood that we're going to incur a loss. It is typically defined as being 90 days or more in arrears on either interest or capital. So that is the most basic indicator of a default, but you have to consider the context of the particular loan that we're dealing with. Maybe 30 days would be more appropriate in your circumstances. The 90 days is the standard definition. It may be sooner, and it could be driven by specific credit events like an event of bankruptcy. Now, that would vary according to jurisdiction. So each country would have its own definition of what is a bankruptcy within that country, but any bankruptcy event is a strong likelihood of a strong indicator of default. Another indicator of default would be the borrower saying it's not in a position to make repayment. So there are other definitions, but the objective one is the 90 days. My loss given default is my question. If there has been a default, how much will I lose? Now, the loss is the one minus the amount recovered. So if I recover 40%, I lose 60%, in other words. What could my recoveries come from? Well, recoveries are very often in the ordinary course of business. There are payments that are made late. But I'm also got the opportunity to get recoveries through a collection process. Each country would have bankruptcy laws, and there would be a basis of which these are applied, and there could be a forced sale of assets, and I would recover something from it. Where I'm relying on some sort of bankruptcy process, the status of the loan is very important. So are we dealing with a senior loan? Are we dealing with a subordinated loan? There are a whole hierarchy of loans, and you're going to need to be aware of what it is. Nothing else stated. If there is no clear indication, you'll need to check the financial statements and know about any other legal agreements. It's going to be a senior loan. You may have specific items of collateral which places you above other creditors in the status, or you may have some other external source of repayment, which could be a guarantee from a third party, it could be credit insurance. These will all reduce the loss, so you'll have a lower LGD. When we are measuring our potential loss given default on a loan, where the loan is made to an entity that owns assets that are easily realizable at an objective price, such as a real estate or property investment company, we will often look at recoveries through an immediate sale of that property. And there is a difference between a fire sale value and a short-term sale. And it's important to consider which of those two are applicable depending on the circumstances. A loss given default may often be based not on the full write-down fire sale value, but an ordinary forced sale. But then you would need to take into account the time value of money of the time delay in order to realize the asset. So on a practical sense, you are obtaining the value of a property because you've got a loan to a property owning entity. There are likely to be probably three different values. The one would be the ordinary market value of the property. The second, which would be relatively close to it, would be a forced sale with time. So that's where you're going to say, we need to sell that property to repay the loan, but it may take 3 months, it may take 6 months in order to realize that property. The third value is a fire sale value, and that is where we say, we are putting that property on auction next week, and whatever offer we get, we're going to accept. And you need to consider the circumstances of your loan to determine which of those three values is most applicable. Whereas a loan to a related party, you can often justify that the lender would be prepared to wait to obtain a closer to full market value and would not rely on a fire sale value, but you'd need to take into account the time value of money. Right. Coming back to my definitions of loss, the third element, which is usually a very simple thing that we don't have to focus on, and that's why I put it last, is my exposure at default. So if there is a default, how much will be owing at that point? So we're measuring our future losses. So we need to know how much will be at risk at that date. For related party loans, it's usually the amount owing. And you don't have to worry too much about this element of it. It might be a little bit more complex where there's an expected repayment or drawdown close to your measurement date. Where it's going to start to become a factor is when we're looking at a stage 2 or stage 3 loan, where there is a longer term. So we are measuring the risk over a longer term. So those are my three elements of risk: my PD, my EAD, and my LGD. Now what I'm going to do is come back and look in more detail about the practicalities of how I measure the risk of, and looking at each of these three elements separately. So my starting point is my PD, my probability of default. So there are a number of different methods. There are credit ratings. These are the easiest to apply, but I'm just going to tell you now, before I get into some detail, there are some spoiler alerts. It's not always as simple as it appears. And unfortunately, we can't just apply this to everything. One of my spoilers is there's a limited number of entities that have ratings. So an alternative techniques for entities that are not rated would be to estimate ratings. But just a caution, this can always be done, but it is hard work to get the answer. The third most common technique would be to build a credit model based on the internal history. Now, when it comes to related party loans, it is unlikely that I'm going to be able to use this technique at all because there's insufficient transactions to do it. So in order to build a model, it's got to be a statistically valid model, and I need a significant sample. It's much more likely that I can build a model on, say, trade receivables, where I've got a large number of debtors, and if I'm using a multi-year history, I've got a large number of transactions. A lender, a bank or a non-bank lender that's got a large portfolio would also be able to use their internal history. But on related party loans, it's unlikely that I'm going to have the type of sample that's required. And remember, I don't only need sample size in terms of number of borrowers, I need defaults as well. So it is unlikely to be an option. What I can use is an externally produced credit measurement model, but it has to be applicable to the circumstances. So let's drill down into these techniques and look at practically how we would do each of these. So using ratings, there are three major international rating agencies. S&P Global, used to be called Standard & Poor's. There is Moody's Investor Service, and there is Fitch Ratings. Those three are global rating agencies that have extensive coverage around the world, and they provide ratings, AAA, AA, etc., all the way down to C's, and that describes the credit risk of who they rate. There are, in a number of countries, local credit rating agencies, but I am limited to using the three major international agencies. And the reason for that is that they publish a mapping from their rating to a probability of default. So every year, the three rating agencies will put on their website, and it's available for free to any registered user. I would suggest that you choose a rating agency as your primary one. As a general rule, S&P and Moody's have got slightly wider coverage than Fitch, but you might find an entity is rated by only one of the three or two of the three. So sometimes you're going to have to look at the others. Our agency of choice is Moody's, because we work with a lot of their other tools. So I know that I can look up on a table that Moody's publish once a year that says, if it is a Ba2 rating, this is what the probability of default is. The challenge with that is that they tend to publish this 1 to 2 years in arrears. So Moody's have just published their 2019 numbers. They've not yet published their 2020 numbers. So the current mappings, they update these mappings every month, but that is only given to paid subscribers. It is important to note that the PDs change significantly over time. So a BA2, what is the percentage PD? Each year is slightly different. And what we do know is that COVID-19 has had a huge impact on credit risk, and the mapping from PDs, from ratings to PDs, has been very, very volatile. So if you recall, at the beginning, I spoke about converting a general measure of the risk to what is the risk today, and that is specifically what we are referring to when it comes to using ratings. A few other points to keep in mind: you've got to check that you've got the right ratings. There are different types of ratings. They have local scale and international scale, local currency. All of these, as a general rule, you want a rating for a senior unsecured, unless you've got a specific debt instrument, in which case it needs the rating on the right instrument, and you want it on an international scale, because if it's not an international scale, the mapping to PD will not be right. Very important point to take into account is that the relationship between PDs and ratings is not linear, it is logarithmic. What that means is that each rating notch, an individual rating is called a notch. So what we have is Moody's. Each of the three agencies have slightly different descriptions. So I'll just talk about the Moody's ones, but they're equivalent on S&P and Fitch. Has got AAA, AA, and single A. Within AAA, it's just AAA, but AA, you would have AA1, AA2, AA3. The movement from AA1 to AA2 is a notch. The movement from AA3 to single A is a notch. The lowest A would be an A3, and the next notch down would be a Baa1. Now, very roughly speaking, a notch movement is a doubling of the risk. It's not a 10% or 5% increase in the risk. It's more or less a doubling. And because it's a logarithmic scale, in percentage terms, your PD is very low in the A's. So at AAA, it's a fraction of a percent. Even at AA's, it's significantly less than 1%, but it grows very, very quickly through the Bs. So what that means is getting a measurement wrong on whether it's a AA1 or AA2 is not going to materially impact on my ECL. But getting a one-notch difference on a BA3 versus a B1 could well result in a material difference on my ECL. Final point that I want to make about ratings is that ratings coverage is limited to entities that are active on capital markets. So
Lawrence, we can't hear you. Hello? Sorry for this. Let me contact Lawrence. Maybe he had an electricity outage because I heard a beep. So let's wait for Lawrence. Roche, can you contact Lawrence so we know if he's okay?
I'm doing so. Thanks, Harry. I'm checking.
Sorry. Hello?
I'll tell him. That's fine.
Hello?
So, Harry, Lawrence is safe. That's the good news.
Nice.
In South Africa at the moment, there are challenges with electricity, and they have something called load shedding, which says each area will sometimes not receive electricity for 2 to 4 hours, and
So
that
you mean
sometimes
that
happens
we might
randomly.
So
No.
you mean that we might lost Lawrence for 2 or 4
No.
hours?
Yeah, he's just trying to see if he can get on another internet connection.
Okay.
So there sometimes is both fiber and the mobile network. So he's just he'll let us know.
Okay. Until he comes back, maybe we can also continue.
Okay. He is trying to get back in.
All right.
So while we're waiting for Lawrence, perhaps are there any questions relating to probabilities of default or ratings? The one interesting thing is Moody's would publish their mapping table between ratings and PDs at a single point in the year. And with COVID coming in a South African context, and generally with a number of European companies that we've worked with, we have generally said that December 2019 year ends where COVID was around. But if you look at the impact on capital markets, there really wasn't an impact that came through until sort of February and March. And a lot of audit firms argue that as at the end of February, there's a case for not applying a COVID premium on the probability of default. But certainly from March onwards, the probabilities of default would have increased dramatically. And what we've seen using the Moody's tools are that the probability of default could have jumped between 4 and 6 times between February and March. There are a number of the big 4 audit firms that have their own predictive tools and models that look at probability of default. And they plug in very often just changes in GDP. So it's not a very sophisticated model. And they feel comfortable that it'll give them a range of answers that are sufficient for audit purposes in normal times. But when it came to the significant decreases in GDP, the amount that they were putting up their probabilities of default were sometimes 7 to 10 times. So if the probability of default as at December 2019 was 4%, very often they would be coming out with between 25 and 40% probabilities of default based on their models. So the Moody's models and that of the large rating agencies are much more sophisticated. They don't just look at GDP, and they had much smaller increases in probabilities of default over COVID. And as I said earlier, very often that jumped between 4 and 7 times.
Okay, thank you,
Lawrence, are you back?
Lawrence, back. Yeah.
Hi, can you hear me?
Yes, we can hear you. Thank you for joining.
My sincere apologies, but I am back now. Sorry about that.
Okay, so you can continue. We just had Roche to fill in your the time that you were not here. Thank you, Roche.
Thank you, Roche. Okay, so I spoke before I was cut off. We're talking about ratings from rating agencies. Now I am going to look at option 2 for measuring our probability of default, and that is estimating ratings. So this is where you don't have ratings for an entity. What you can do is estimate what the rating is of that entity. So what happens is the rating agencies publish, and this is available for free to any registered user of their website. They publish the methodologies that they apply to determine the ratings in each industry. So they have different methodologies in each industry, and they give detailed descriptions of all the factors that they take into account. And they even give the ranges of key financial ratios that you would expect to find associated with each particular rating. So it is possible for you to work through this methodology. And if you're doing this, I would recommend that you are taking into account peer analysis. In other words, this is my company. These are rated entities in the similar industry. This is their rating. How do we differ from those? And through that, you can estimate a rating. What I want to say is that it's a complex and a time-consuming exercise to do, but I would assume that any accountant is technically competent to be able to do it. But I would just point out, it's a bit like your clients completing their own tax returns, that very often they are technically competent to do it, but they are going to take a lot more time and they're much more likely to make a mistake than a person who's an expert on it. And similar thing, credit ratings and being a credit analyst is a highly skilled profession. So just bear that in mind. For unrated entities, another alternative is to use a credit model. And there are credit models that are commercially available that measure the risk based on characteristics of the debtor. And this is a very efficient and useful way of measuring the PD. IFRS 9 specifically allows for an external credit model, What it cautions is that the model needs to be created based on data that is relevant to your situation. So what will we call relevant? I would say we're going to be looking at the geography. In other words, what country data was used to create that model? Is it the right industry? Is it the right nature of entity, size of entity? So in other words, I can't use a credit model for consumers for a business entity. I'd be careful about using a large corporate model for small micro entities, et cetera, et cetera. When you are looking at a credit model, you need to quantify the risk. So you need a model that provides you with a PD, a probability of default, not one that just gives a score unless you can credibly map that score to a PD. So please take that into account. The only downside to a model, because they're quick and easy to apply, so they're very efficient, is they do come at a price. And particularly when you have just a small number of measurements to do, it can be quite costly to do it. One of the most commonly used models for unlisted companies is a model produced by Moody's Analytics called RiskCalc, and that's based on financial statement inputs and compares a particular company's financial statements to a very large sample of companies, enables you to measure the PD. So those are my options for PD, and my practical example I'm going to work through shortly, we will go through those now. Measuring my LGD, we need to take into account the seniority. Are you secured, unsecured, senior, subordinated? Is there collateral? Are there other mitigants, including guarantees and insurance? And I also need to take into account the leverage of the entity based on tangible assets. There is also research from the rating agencies on recoveries per asset class. And what I alluded to earlier is you can give reference to breakup value of assets, and that's very easy to apply to investment companies and property companies where it's something that can be sold easily. So these are just some of the screens from our tool that does it, which just shows you some practical questions that enable you to determine all the different possibilities on taking into account the requirements to measure the LGD. So once I've got my risk, my PD, my EAD, and my LGD, I need to consider my staging. And my staging cannot be done prior to this point, as I'll explain now. Staging, just to remember, stage 1 is for your ongoing performing, everything other than my stage 2 and stage 3 assets. My stage 2 assets are where I've had a significant increase in credit risk since the loan was originally granted. And my stage 3 is my credit impaired. These are ones which are written off. So my stage 2 are the ones which practically are the most difficult to do. And what we need to do here is we need to consider whether there's been a significant increase since the loan was originally granted. For intercompany loans, there is a challenge where we don't know what the original date of the loan was and what the risk was at that time. That is a very common situation for related party loans. I think there was an assumption that when IFRS 9 kicked in, although it's not fully just explicitly stated, I think common practice said, let's assume that on day 1, it was stage 1, and we look at a significant increase since then. But if on day 1 it was very high risk, there could be an argument for it to have been in stage 2 from that date. Every company has to have its own definition of significant increase in credit risk, I would advise to have some flexibility in the definition where you are helping your clients determine their accounting policies. And the reason for that is that if you have it based on a fixed objective financial criteria, you have no wiggle room, and it could be a technical reason that invokes that criteria, which is not an increase in risk, and that's going to do it. So if you have, these are the indicators, but the actual increase is determined by an internal committee or something like that, you've got a bit more flexibility on that. I want to point out two commonly accepted specific indicators of significant increase in credit risk. One is a one-notch increase in a rating. So if a rating, a downgrade by 1, so if it goes from a BA2 to a BA3, that would be a significant increase in credit risk. And then the second thing would be where there is a breach of a loan covenant. That would typically be regarded as a significant increase in risk. So if I have lent money to another group company and that company has breached its loan covenants with its own bank, that would be regarded as a stage 2 loan. On a time basis, where you have more than 30 days in arrears, as opposed to the 90 days, which is default, more than 30 days in arrears is usually regarded as an indication of a significant increase in credit risk. These are our template for how we help measure that. Now, I want to come back to very briefly the second part of my loans repayable on demand. And you'll recall that I raised those at the very beginning. And I said, there's no need for an expected credit loss where there was sufficient cash on hand to repay the loan. I now want to look at the second scenario, and that is where there isn't sufficient cash on hand to repay the loan. Now, what we then say is that loan is in stage 2. By definition, if we don't have sufficient cash on hand to repay the loan, it's a stage 2 loan, even if the risk is low. What I now have to do is to determine how long it's going to take to repay the loan. And my best reference point would be to look at the cash flow generation ability of the debtor company, of my borrower. Let's look at the cash flow of the borrower. And one very good way to do it would be to measure the debt service cover ratio, because that would tell me how many years it would take that entity to repay its debt. And I would then need to measure the expected credit loss over that term. On a practical basis, you're going to have instances where my debt service cover is either negative or an extremely long term, 10 years, 20 years, something like that. It is accepted practice to put a maximum amount on that term based on the finance plans of the entity. So you might say, well, within the next 5 years, the entity will be looking at all its borrowing requirements and will be looking at refinancing all its debt, and therefore we can assume it can be repaid by the end of 5 years, and therefore I'd apply a 5-year term. So now moving beyond the specifics of repayable on demand, this is applicable to all loans that are in stage 2, including those which are repayable on demand. I need to measure the risk over the term of that loan. because I'm now looking at lifetime losses instead of 1 year losses. So what I want to point out is that my PD will be significantly higher where I'm looking at lifetime. If it is a 2-year PD, instead of only having 1 year to default in, I've got 2 years to default in. If it's a 3-year loan, I've got 3 years, etc., etc. The only slight positive news on that is my year 2 PD in percentage terms is slightly lower than my year 1. So in other words, a 2-year PD is slightly less than double a 1-year PD. And that's simply, if I survived year 1, the chance of me surviving year 2 are higher. So my PD is going to be significantly higher. My EAD, I now have to consider how much is likely to be owing. So if there is a repayment schedule or new drawdowns expected, I will need to take that into account because my amount at risk may be higher or lower than the current balance. My LGD does change a little bit, but only by small amounts when compared to the PD. So I don't have to worry all that much. I do have to take into account the term of the LGD, but it's not as much a factor. So I've got all these factors. I've now measured my PD over the appropriate term, my EAD, and my LGD. What I have to do is convert my PD to the current PD rate. If I've used an internal model or external credit model or ratings, those are often based on averages through a multi-year history. That's why I need those annual mappings from ratings to PDs. If it is a credit model, I might need to adjust it from what we call a through the cycle measurement, which would be the average over different points in the economy, be it a recession or a growth period or anything like that, to the point in time. Where am I as of today? Now, there is a whole lot of financial theory that enables you to mathematically determine it based on economic cycles, but I'm going to point out to you, this is very complex financial mathematics involved. I am a very experienced credit analyst. I wouldn't dream of performing that calculation myself. I would use a quantitative expert in financial mathematics who has a very in-depth understanding of economics to perform those transformations for me if I was doing it manually. Remember, we're in very volatile times because of COVID, and these changes are significant at the moment. So I've converted my average risk to today's risk. Now I've got to convert it into forward-looking expected credit loss. This is where I've got to consider different macroeconomic scenarios. So what we're saying is my base case is my best case, my optimistic, my pessimistic. As a basic, I would say you probably want 3 different cases. Sometimes you might need more. Maybe I'm going to have 5 cases. There's no preset way of doing it, but I would say it's probably a minimum of 3. Now, GDP growth is definitely an indicator of credit risk. In other words, when GDP is growing in a country, the credit risk is getting less. And when the GDP is shrinking, when we're in a recession, the credit risk is getting more. But I want to caution against a single factor, because the volatility of a single factor can lock you into some strange situations, and those people who chose a single factor model based on GDP 2 or 3 years ago have got themselves into a very difficult situation over COVID, because We have seen massive swings in GDP over COVID, and it is not good practice to be changing your basis of measurement to suit the circumstances. So if you decided 2 years ago to use GDP as your forecast basis and GDP on its own, you are going to have wild swings in your ECLs through 2020 and 2021. So I would say it is preferable to use more than one factor. I would say that there are what is also known to be a predictor of credit risk are market factors, volatility on equity index, prices of CDSs, etc., etc. It is difficult to identify the right factors. So if you're just going to use general economic factors, you might be in a sort of pure intelligent guesswork type scenario, which is difficult to justify. But without very large data samples, it is difficult to prove mathematically a correlation between historical default rates and economic variables. The rating agencies and other economic research organizations do publish these kind of factors, but it is always paid for research. So you're not going to be able to obtain that for free. And remember, you don't only need to know the historical correlations, you also need a forecast, but there are credible sources of forecasts. Most countries' own finance ministries and treasury central banks will produce forecasts. The IMF produces forecasts for many countries. The World Bank produces forecasts for many countries. So you can use all of those. So my final few points before I work through a practical example is I do want to say that it is possible to measure ECLs on related party loans complying fully with IFRS 9 without undue effort. You just need to have the right techniques and do it correctly, and it's possible to come up with a credible and defendable answer. Because they're related party, we are assuming that information on the borrower is available. If you're using out-of-date financial statements, you're at risk. So I would highly recommend that you supplement historic financial statements with latest management accounts to have current information. And then a final point is on the volatility of today's environment. What we've seen is that ECLs were 6 months ago typically more than 3 times historical averages due to the volatility in the economy. We are now settling down a lot. They are reverting to more normal levels, but I don't know what the economic impact of the second and third waves will be, and it does seem like it's going to take us a little bit longer to gain all the benefits of the vaccines from COVID-19 before the economy reverts to normal. So I don't know as of now how ECLs are going to move over the next 12 months. It's going to be complex. It's going to be volatile. So this is a type of ECL report that you might want to have to show where all your numbers come from. And basically what we just show is per asset, my PD, my LGD, I multiply the two to come up with my through the cycle loss. I then convert it to my forward-looking expected credit loss. And I may need to take into account a sovereign risk factor if it is a loan in another country. This doesn't explain everything I've done, but this highlights the key numbers that go into my expected credit loss. I would then probably want, as evidence in my file, some sort of explanation on how all those numbers were calculated. There are a lot of complexities. We typically ask more than 30 questions in our decision tree when we're approaching an intercompany loan. So just remember, you've got to get things right. Just a few specific things I'm going to point out. If you're using ratings, use international scale. Your global scale ratings are not the same as local scale. And where we talk about mappings from PDs to ratings, they are always the global scale. When we're looking at the situation where there is some sort of subordination of a intercompany loan until its current assets exceed its current liabilities, it's a very common thing that is required where there's technical insolvency in a balance sheet. We need to calculate the period until which that subordination will last. In other words, how long until the assets exceed liabilities. That will be a key thing for my LGD and the term of my PD. Just a caution, don't Google ratings. They are very often wrong. You need to go to the website of the rating agencies and look it up. Ratings can change at a moment's notice, and Google doesn't tell you whether it's today's rating or last year's rating. Sometimes the rating stays the same for years and years. Sometimes it changes 3 times in a month. So please don't get a rating wrong because Google told you it. You need to go to the website of the rating agency. Then you need to take into account restrictions on repayment. There could be a sovereign risk factor. The rating of an entity can be no better than the rating of the country in which it's based. And that is particularly important when you've got a loan to a subsidiary based in a country with a poor rating. There may be restrictions on repayments due to loan covenants. Please remember that. And final point I'll make just on complexities is my mapping of ratings to PDs. Make sure they're current. Right, so I've got a practical example which I'm going to work through, but I want to just see whether there are any questions that I want to address quickly. And I'm going to have a look at the questions that were posed.
Yes, we have 2 questions, actually 3. One is from Anita Guzari, if you want to have a look at it.
Okay, let's just see. Sorry, I'm just struggling to see it. Can you?
Yeah, of course.
Okay, can you read the question aloud?
Yeah, of course. What if none of the 4 methods stated apply for a small entity? Do you have any other suggestions on how to calculate the PD on intercompany loans for small entities?
Okay, so what I would say, if there is a possibility that it is impossible to calculate the PD, and that is because of either uncertainty or lack of information. If that is the case, I should assume that the PD is 100%, and the only thing that will reduce the risk will be the LGD. So let's say you cannot obtain any financial information about the borrower. I just have to assume that the PD is 100%.
Okay.
Of the techniques that I mentioned, I would say as long as you've got some information about the borrower, I should be able to estimate a rating based on reference to other rated entities and the industry in which it's in. But I would just apply conservatism to my rating. In other words, add an additional notch or 2 notches or even 3 notches due to uncertainty if I don't know if there's a large amount of uncertainty. But the worst case scenario would be to assume 100% PD. I hope that answers the question.
Okay, thank you very much, Lawrence. The second question is from George Strovolidis, and he's asking, first we had historic cost accounting, then current value accounting, revaluations was added. Now we have future value accounting. Can the 3 bases coexist?
Yeah, so that is a very, very good point. And I think what we are seeing here, and I know that IFRS 9 can be complex and it can have results which can sometimes appear to be crazy. And sometimes you say it's meaningless. I don't know why I'm making this provision. How do I explain this to anyone? But what IFRS 9 is attempting to do is to correctly measure risk. And we are moving into a general world of accounting where we are moving away from a simple valuation based on what the historic cost was, and rather looking at risk based on probability of outcomes. So probably the first IFRS requirement in this regard was looking at valuation of share options, where we had to suddenly look at a valuation of a share option based on future possible outcomes. And I would say this is the overriding trend in accounting, and it's going to be getting more and more. We are going to say, in the old days, we used to say 1 + 1 = 2, that is it. It was a binary approach. If someone owed you 100 euros, that loan was either worth 100 euros or it was worth 0. And you would keep it on your balance sheet at 100 euros until it became 0. That was a very binary way of doing it. Now we're saying 1 + 1 isn't always 2. Sometimes they don't pay you back. So we're saying, well, normally that 100 euro loan is worth 100, but sometimes they're not going to pay you back. And if I take 1,000 scenarios and run them over and over again, I can work out that in 98% of the time, I'm going to get all my money back, but in 2%, I'm going to lose it all. So therefore, that 100 euros is not actually 100 euros, it's 98 euros. And that is what the accounting philosophy is increasingly becoming. That is always how insurance companies, so actuaries, have always thought this way. And I think as accountants, we need to learn to understand risk-based thinking more and more. So yes, it's a real change.
All right, thank you. The next question. I don't know if it's a question. It's a request, I guess. It's from Antonis Antoniou, and he wants to have the Excel for something. I think you were showing a table, and maybe you can explain how someone could reach to that ECL reporting Excel, as he's now clarifying.
Yeah. So,
Lawrence, can I jump in here?
please, Rosh, would you care to answer
Perfect. Thank you. So, Antonis, we are very happy to share some of the pretty reports that we've created in Excel. you know, they're just a nice way to lay things out, and we can share that with the greatest of pleasure, and we can do that next week. The tricky bit, which we'll cover in a moment, is how you actually automate that and how you come up with the right answers. So we'll see that as we go.
All right, thank you very much. So if we don't have any other questions, then Lawrence, you can proceed.
Okay, brilliant. I'm going to carry on with my worked example. So
Thank you.
I'm now going to implement everything I've spoken about. It's not going to take me all that long to do, but I'm going to run through a practical example. So we're taking a situation that you're calculating the ECLs for a Cyprus-based company. I've just called it ABC Europe. And that company has made 2 loans to fellow subsidiaries, ABC Netherlands and ABC Argentina. All 3 entities were part of an American group called ABC Group Incorporated. And we're doing this as of 31st December 2020. Now, the loan to ABC Argentina is for $1 million, and there is a guarantee by the holding company to ABC Europe for the full amount of the loan, and that was because of the very high sovereign risk of Argentina. That loan is repayable in 2023. The loan to ABC Netherlands is $2 million, and that's not guaranteed, and that is repayable on demand. Now, for the purpose of this example, I'm saying there's no interest payable on these loans, and I'm ignoring any implied interest based on opportunity costs of funds or anything like that. The reason I'm doing this is I want to ignore the time value of money calculations that are a part of IFRS 9 so that you can see the specifics of how we calculate this part. If I had interest, I would be discounting all future cash flows at my interest rate. So that's just a key example assumption to help illustrate the points better. So let's look at my loan to ABC Argentina. First thing I need to consider is, where is the risk? Now, if that's been fully guaranteed by the holding company, I am going to assess the risk of that holding company because I know that the risk of the holding company is lower than the sovereign risk of Argentina, and the risk of ABC Argentina can be no better, the risk can be no lower, the rating can be no higher than the sovereign risk of Argentina. So ABC is rated BA2. So this is ABC Inc., the American holding company, is rated BA2 by Moody's Investor Service, and it's been at this level since the loan was granted. What we know is the BA2 rating is better than the sovereign risk of Argentina. Therefore, I'm not really all that interested in the risk of the borrower. I'm only interested in the risk of the guarantor. Because the rating has been constant, I can say that this is a stage 1 loan. Therefore, I'm only need to calculate a 1-year ECL. I went to the Moody's website and I downloaded a document that gave average default rates per rating category up until 2019. And I've determined, they published them for different industries, and I've determined the applicable one for a BA2 rating was 0.71% 1-year probability of default. Now, what I need to say is that was an average up until 2019. What is my risk as of 2020? And I've got to say, we're in very high risk times due to the volatility of IFRS 9. And I'm just going to judgmentally assume that it is 2 times the average risk. So I've adjusted the 0.71% to 1.42%. Does that make sense? Now, I need to work out what is the LGD. So again, I went to the same Moody's report on their annual default studies for 2019, and what they said, the historical average recovery rate on unsecured bonds, and this is in the consumer non-durables industry, which I assumed we're part of, I determined that the LGD is 68.02%. If I multiply the 1.42 times by 68.02, I get a loss of 0.97% as of 31st of December 2020. Right. So that is my loss as of that date. I now need to take into account my future scenarios. And I've decided to work with three scenarios: a base case, an optimistic, and a pessimistic. And I've looked at my GDP growth forecast, and I've also looked at the level of the VIX index. The VIX index is an index that is published every day. You can Google it. You can get the number. It's reported quite widely within the financial press. The VIX, I can't remember what it stands for offhand, but it's a volatility index and measures risk across a wide class of assets on the market, and is a very good proxy for general risk of the risk environment. And the VIX is correlated with a large number of risk-related assets, very often used to help explain movements on foreign currencies and things like that. So that's why I used the VIX index. And what I've said, and this is just a judgmental assumption, my base case is that the current risk is that the future risk for the next 2 years will be 20% higher than current. My optimistic scenario is it will only be 10% higher than current, and my pessimistic will be 40% higher than current. Now, if we're in more normal times, my pessimistic would probably be my optimistic scenario would probably be negative. In other words, the risk today is, in fact, my future risk is lower than the current risk. What I've then done is I've just estimated that I'm going to weight these scenarios 50% base case, 25% optimistic, 25% pessimistic. And if I multiply these across, I get a 22.5% increase in the risk. So that is 50% times by 20, 25% times by 10, 25% times by 40. That is 22.5%. So I then say, if I take the 0.97%, which I measured on my previous slide, I multiply that by 1.225, I get to 1.18%, and that results in a 1-year ECL. 1.18 times by $1 million is $11,800. And that is the ECL on the loan to ABC Argentina. Let's have a look at the loan to ABC Netherlands. This is repayable on demand. We've looked at the balance sheet as of December 2020 from the management accounts, and there are insufficient funds available to repay the loan. So I cannot assume that there is a zero ECL. So now I have to estimate the term. I took that balance sheet and I calculated a debt service cover ratio. And from that, I could see that it would take me 2 years to repay the loan. One further complication is that ABC Netherlands has local funding from a local bank, and that bank insisted that all the group companies have subordinated its claims in favor of the bank for the next 3 years. And ABC Europe has agreed to this. So in other words, ABC Europe's claim against ABC Netherlands has been subordinated to the local bank. Now, ABC Netherlands, there's no rating for it. What I've done is I've used a financial statements-based PD model provided by a third party. I put in the required inputs from the financial statements, and the model told me that I have a 1-year PD of 4.82% and 2-year cumulative PD of 8.73%. The model is giving me a point-in-time measure at the 31st of December, so I don't need to adjust that number further. The model also gave me an LGD, and what it said is a subordinated debt for this company would be 73.68%. So if I multiply the 2-year cumulative PD, the 8.73, by the 73.68%, I get the 2-year loss rate of 6.43%. I apply the same 22.5% increase, and I come up with an ECL rate of 7.88%. So that's 6.43 times by 1.225. I multiply that by the $2 million loan, and I get an ECL of 157,590. So that all seems very simple. I could do that in 3 minutes. Well, there are a lot of elements in this, and let's say someone had to say, are you sure you're right? What I'm going to say is some of the assumptions I've made here are easier to defend than others. So let's have a look at what I've done and where my risks lie. And I want to point out something very important. An ECL is not meant to be a prediction of credit losses. So in other words, if that loan did or didn't default, it is not my vindication that my ECL was right. My ECL is meant to measure the risk as of that date, regardless of whether it does or doesn't actually go bad. So where's my risk? Assumption 1, if I look at my first loan for Argentina, that I base the risk on the holding company, my challenge would be, should I not be considering ABC Argentina itself? I can answer this challenge. I can say this risk is low because it is established credit practice to base the risk on a guarantor. So you would take the lower of the risk of the guarantor or the borrower. I can answer that question. My measurement of PD is based on a rating. Can I assume a PD from the rating? Again, I can defend that. I can say that the 3 major international credit rating agencies have been publishing historical defaults per rating category for many, many years, and any rating from a reputable rating agency, I can assume a PD from it with a high degree of credibility. I can defend that assumption. My third assumption is that the risk as of December 2020 is 2 times the risk, the average risk that was measured at 2019. Now, this is a much harder one to justify. How did I measure this? Well, in truth, I've just estimated it. I know that in general, we're in riskier times, but how did I know that that was 2 times? And that is certainly something that I would have trouble defending if I was challenged. There are proven methods to determine this, but I would say that it is difficult to apply these. If you go to Google Scholar and search out conversion from through the cycle measure to point in time, you'll see numerous PhD theses on this that have pages and pages of financial mathematics that are extremely difficult to follow. So there is a right way to do it, but it is hard. So I'm at risk on that assumption. My next assumption, my LGD are based on the average recovery from an unsecured bond. How do we know that the actual risk is right here? Have I ignored the specific capital structure of ABC Limited? How do I know a bond will be the same as a loan? Well, these are valid challenges. I think that it's probably a defendable assumption, but arguably I should be taking into account the specific capital structure of ABC Inc. more into account, and an LGD model that takes into account the leverage of the entity would probably give me an answer that's more defendable, but I may be able to get away with that and defend that one. My next assumption, the forecast for GDP growth, this is for the forward-looking ECLs. I've used GDP and the VIX. How do we know that there's a correlation between these and the specific loans that we've got here? My other challenge that could be easily made is I've assumed the same risk for Argentina, USA, and Netherlands, whereas in fact, the forward-looking should vary by country. I'm on shaky grounds on these assumptions. I should be looking for a specific correlation and measuring the correlation between my factor and changes in credit risk in the environment. The problem is without data, it's very hard to do this. So if I haven't subscribed to research published by entities that have data, it's very difficult not to just be taking a guess on this, and I'm going to be at risk of having an undefendable assumption there. The weighting of the forecasts, where I said 50, 25, 25, how did we determine these? Again, I've just estimated these, I've just guessed. They are not uncommon scenarios. Perhaps you should be looking at 40, 30, 30 rather than 50, 25, 25. You know, there's lots of different ways of doing it. But again, without research, which is only rarely available as paid subscriptions, it is hard to prove your weightings, and it's going to be down to professional judgment. I'm going to be at risk if I'm challenged on it. My next assumption, I come to the detail of the Netherlands loan, 2-year repayment period. How can I say that we know it's 2 years? Well, there's no certainty because we're looking at future cash flow. We're predicting how long it will take. But I would say a debt service cover is an accepted, established proxy for determining future cash flow generation. And that is something I can defend. I would not have a problem answering that question. The next thing is measurement of 2-year PD for ABC Netherlands. Well, I've used my credit model. How do we know that the model's giving the right answer? Well, all depends on, has the model been built on data that is applicable to ABC Netherlands? Does it include Dutch data? Does it include the right types of companies, the right industries and everything like that? And if that's the case, I'm good and I can defend that assumption. Similarly, my measurement for LGD for ABC Netherlands, how do we know? It's the exact same answer. As long as my model was based on the same data, I am good on that assumption. So that is my worked example on it. I know I've been through it very quickly, and I'm certainly happy to address any questions on it. I know we did mention in the agenda that we would briefly cover other assets, typically what we need to look at on IFRS 9 are trade receivables, bank accounts and fixed income investments, and guarantees. We're going to have to cover them on a future webinar due to time constraints. So what I do want to very briefly cover is managing efficiency, cost and risk. And I'm going to hand over to my colleague Roche on this.
Just before going to, just before going to Roche, we can also reply to some questions, if it's okay with you, Lawrence. It will only take 1 minute. Lawrence?
Certainly.
Yeah. So Despo is asking where we can find the rating maps that give you the percentage for specific categories for probability of default purposes. And she's saying that she have searched the Moody's website, but she couldn't find them.
Okay, so Moody's, S&P, and Fitch, you need to register on their website. And then if you have a look for a document, they've all got slightly different names. On Moody's, they call it their annual default study. If you Google the Moody's annual default study, you will find it. S&P, I think, also calls it the default study, if I remember offhand correctly.
All right, thank you very much. And there is a question from Iliana Mishova-Georgiou. What does DSC stands for? But I was going to write it down, but you can reply here as well.
Yeah, my apologies. I should have explained that a bit more. It's a debt service cover ratio. So it's a standard financial ratio, very commonly used within banks and lenders. And what it does is it takes the profit of a company, adjusts it to a sort of proxy for cash flow by adding back depreciation, amortization, and other typical non-cash flow expenses or income. It then adjusts for movements in working capital. It then takes off capital expenditure and says that is the sustainable cash flow of the business. And then you say, what is the total debt? So typically what I wanted, if I want a more accurate number, if I've got the current portion of long-term debt, I would deduct that and then say, if I take my total long-term debt, how many years of cash flow would it take to calculate it? That is my debt service cover calculation. Again, if you Google it, you will find definitions of it and worked examples on it. It's something that you can calculate from a company's financial statements.
Okay, thank you very much, Lawrence. We are done with the questions. We can now go to Roche.
Ευχαριστώ, Harry.
Παρακαλώ.
Lawrence, could you move down one slide?
Certainly. Sorry, give me 1 second.
Thank you.
Right. So that is who's talking to you.
Thank you. So just by way of introduction, I know the CMS guys well. I have been to Cyprus as part of Caseware conferences and have met with them in Europe and Canada Caseware conferences many times, and have worked with them on audit methodologies, in fact, over the past 10 years. So we know each other well, and yeah, just like to thank Harry and the team for arranging this. I was the co-founder of Caseware in South Africa and Africa, and we built that up into a team of about 100 people, and we built the templates for audit and for financial statements and tax all the way across Africa, and built that into the dominant business. So the way that I think in business is to build tools which are flexible, which cater for a number of different needs of a number of different situations, that give reliable output, but are very affordable. And that, you'll see, is something that we are trying to do together with CMS for IFRS 9 for the Cypriot and the European markets. So we've been processing thousands of ECL calculations, PDs and LGDs through the Moody's tools for the past 10 years. They are tools that most of the big banks use, and we have a number of big banks and large European companies that are our clients on that. And we have a partnership with Moody's Analytics in South Africa to team up to provide those services for the South African markets. We've been processing, we've been running IFRS 9 projects for large and small audit firms and small and listed companies for the past 3 years or so, and have sort of done 50 major assignments already, and countless smaller calculations. And over that time, we have been able to pinpoint what the questions are that need to be asked, how to automate it, that debt service calculation that you spoke about. We've built tools already that, that just calculates it based on the opening and closing balance sheets of companies. So at the same time that we do PDs and LGDs, we spit out a whole lot more of these particular values, and typically, also work out how long it would take to repay a loan, just as an example. We've also worked with, there are different responsibilities, as we well know, for different stakeholders. A company needs to work out a measurement, which is an estimate, but you actually need to come out with what's called a point estimate. And the organizations which run the international business companies as well should be producing a point measurement. Auditors have some leeway here, and we're able to do range estimates. And a range estimate doesn't have to be as exact. You could estimate something a little higher and something a little lower, and as long as the company's number comes in within that, it's generally a comfortable situation for an auditor. So we've done a lot of these different scenarios and worked with auditors very closely over the past couple of years. We'll deal with some of these items in future webinars, because it's amazing how quickly the time goes. But in essence, what we are trying to do with CMS is trying to see how many management companies of international business companies are interested in using automation services. Likewise for auditors, and we already have some subsidiaries of listed companies that are Cypriot based that we've been working with for the past couple of years. So the tools that really make these calculations very quick and very easy are really expensive. There's a significant upfront investment cost. And from a South African perspective, we can do a lot of these calculations for 40 euros a loan. What we're trying to do is negotiate with Moody's and also bring up the numbers of people who pre-order, so that we can actually reduce it significantly and come in at a level at which it's a no-brainer. So we're busy, we're rolling out the software, and we will keep everyone up to date on that. But the greater the interest shown to CMS on something like this means that we can actually hurry Moody's along, put pressure on them, and come up with a very affordable solution much quicker. So we've spoken to people already within the market, within the Cypriot audit market, and they've said typically, they can spend sort of 1 to 2 to 3 hours putting these things together. The answers that have come out of those calculations have kind of been all over the place, and have also been very, very difficult to justify. we've noticed a number of errors in principle, which would have given a completely different answer. And we think there's a lot of value in the automation process, and we'll be running through that, with Harry, Nikos, Janos, and the team over the next few weeks, and trying to hurry that along. So that's really where we are, and that really deals with how to automate it, how to manage your risk. You're going to get the most correct and defendable answer, and also frees up your teams to work on areas that you're expert in, not areas that you're actually guessing on. Are there any other specific questions that I know we have run a little bit over, Harry, and I know you also want some time to talk.
No, it's
Are there,
okay.
are there any other significant? Are there any other significant questions before we move on?
From what I see from the chat, I don't have anything else that needs our attention. Therefore, I can proceed with the final phase of our webinars today, and which is the IFRS 7, the disclosures. Give me a moment. Give me 1 minute.
Hi, everyone. It's Rosh here again. As we wait for Harry to just pick up his slides, there is something that I did want to mention, and that is we've already produced a number of ECLs for Cypriot companies. And if there are any firms that would like to trial it before we have the full automation going, so you'll get the right answers, you'll get it at discounted prices. All it means is that we'll be doing a lot of the hard work, and it'll be costing us a lot of money to put together until all the automation is finished. But we do need to also understand some of the common scenarios in Cyprus better, so that the user interface and the user experience can actually deal with that a lot more easily. So if there is anyone who's interested in joining the trial, we are ready to move on it next week, and please talk to Harry or his team about that. Harry, are you there?
Harry, would it help you if I put the slides up?
Okay, thank you and sorry for waiting. So my presentation is regarding the IFRS 7 and how we need to reflect all this information that we need to calculate as per IFRS 9. How do we need to disclose them in the financial statements? So thanks a lot to Roche and Lawrence for showing us the methodology used for calculating the ECL for loans from related parties. A very small part, as you can understand, for IFRS 9. And as you all aware, IFRS 9 is too complex and bulky, and therefore standard setters decided to create another standard for the disclosure requirements. And yes, you are right, this is IFRS 7. Sometimes people get confused because they have studied IFRS 9 and they have presented the information as per IFRS 9 on their financial statements. But if you review those financial statements, then you will discover that they were missing the disclosures required by IFRS 7. So this is something that I need to clarify. This standard gives us the opportunity to show the information that needs to be disclosed for all companies that have some financial instruments in the notes or on the face of the financial statements. And as you are aware that 90% of your clients are they need to show this kind of information on their financial statements. So I am Haralan Bosnigolau. I work with CMS System Solutions. I am an FCCA member, and I am responsible for the audit international template in our company. So an overview, this is the agenda of the IFRS 7 financial instruments disclosure, and we will have a look at the overview and objective of IFRS 7, the exception from IFRS 7, disclosure requirements, significance of financial instruments, and lastly, but very important, the nature and extent of these risks and how these are reflected in the calculations and in the financial statements. So IFRS 7 provides the disclosure requirements for all financial instruments. In other words, it describes what we need to tell the users of the financial statements about the entity's financial instruments, which include the financial assets, financial liabilities, and those instruments we use for hedging purposes, if this applies, of course. Why is IFRS 7 so important? Going back to what I said earlier, the users of the financial statement want to understand, firstly, the impact of the financial instruments on the notes of the statement of financial position and the statement of profit and loss and other comprehensive income. Before, as you already said before, I think it was one of the participants that mentioned that before IFRS 9 was released, and of course IFRS 7 was released and applicable, we were very focused to give the quantitative effect of financial instruments. And now IFRS 7 moves to a greater focus to qualitative effect of the financial instruments. Hence, we need to tell the users the type of risk and amount of risk that the entity is exposed to because of the financial instruments and how management has managed those risks. And this is called the stewardship principle. Okay, just confirming that I was okay with the sound. So who needs to care about IFRS 7? Well, all entities that have financial instruments in their financial statements. Of course, there are some exemptions to that rule, and these are the subsidiaries, joint ventures and associates, insurance contracts, employee benefit plans, share-based payments, and equity instruments in line with IAS 32. So IFRS 7 requires certain disclosures for two main areas. The first is the significance of financial instruments for entities' financial statements. if the entity's financial instruments are material, significant, and how they affect entity's balance sheet, profit or loss, cash flows, or performance. Or the second one, nature of risk arising from entities' financial instruments and how these risks are managed. So we need to disclose qualitative and quantitative information about major risks associated with financial instruments. So let's start with the first one, significance of financial instruments. As you can see here, there is the disclosure of the statement of financial position, the disclosure for the statement of comprehensive income, and any other disclosures. In here, we need to disclose all information to understand if the financial instruments are significant for the financial performance and position of the entity. So these are the three groups they are divided. And the first one is in the disclosures of the statement of financial position, we need to show various information about carrying amounts of the financial instruments by their categories, not type, by categories, information about financial instruments at fair value through profit or loss, reclassification, collaterals, and so many other disclosures. I will not go into many details as this is just a summary of the standard. Then we have the significance of financial instruments, the disclosures for the statement of comprehensive income, and we need to show certain breakdowns of gains or losses from financial instruments, interest income and expense, fee income and expense, impairment losses, etc. And on top of those, not that we already had enough of disclosures, we have a few special other disclosures, and these are for the accounting policies, where we need to explain the criteria for designating the financial instruments at fair value through profit or loss, whether we apply trade date or settlement date accounting and things like that. Next, the disclosures for hedging accounting, if you apply it. So we need to describe the risk management strategy, the future cash flows, including amount, timing, uncertainties, the effect of hedge accounting on the financial statements. Finally, there are the disclosures for fair values, and here we need to disclose the fair values of all instruments and also for those who are measured at amortized cost, because fair values are really important to the users. We need to disclose how we would determine those fair values, i.e. major assumptions and information used. If we can't set a fair value for some instruments, then we need to describe why. So these are all disclosures related to significance of financial instruments. And the second category of disclosures are the disclosures related to nature and extent of risks from financial instruments. And these are most commonly, and what we have from the IFRS 7 is the credit risk, liquidity risk, and market risk. Credit risk is the risk where one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. And simply speaking, it is the risk that you will not be able to collect your receivables because your customer cannot pay you for any reason. Liquidity risk is the risk that an entity will encounter difficulty in meeting obligations associated with financial liabilities, i.e. settling its obligations by delivering cash or another financial asset. Therefore, it's the risk in which an entity would not be able to settle its dues. And finally, market risk is the risk that a fair value or future cash flows of a financial instrument will fluctuate due to changes in market prices, and there are three separate types of risks included. First is the currency risk, and that's about the fluctuations in foreign exchange rates. B is the interest rate risk, about the fluctuations in interest rates. And finally, other price risks that includes, for example, commodity prices, equity prices, and others. For each type of risk, we should disclose the qualitative disclosures and quantitative disclosures. What I have prepared is some extracts regarding IFRS 7, paragraph 35F up until paragraph N. And these are taken from the standard and the IFRS disclosure checklist that we have included in certain products that we have that we have available. And also I attached where this requirement of the standard is applicable in the financial statements. That also is a template that we have as a product, so as to be able, you as users, to utilize both the disclosures that are coming from IFRS 7 and also where these are applicable and how you can complete them. So this is the presentation for IFRS 7. We are not going to be going into too much detail, so we need to I will close the webinar for today, and hopefully we will be able to create another webinar in order to give you more details on other aspects of financial instrument, and also how these can be documented in your financial statements. So thank you all for participating in our webinar. We will be communicating with you if you have any questions that you want to ask. All right. So thank you very much.
Thank you, Harry.
Thank you, Lawrence. Thank you, Roche. Have a nice weekend.
Thank you, Harry. Thank you. Thank you, everyone.